In this video, Jim Cramer defends the valuation of tech giants such as Amazon, Meta, Apple, and Microsoft, arguing that their impressive earnings and revenue should not be discounted simply because of their large market capitalization. Cramer questions the fairness of comparing these companies to smaller ones and emphasizes that there's no point spread or handicap in the stock market. He further asserts that there's no evidence to suggest that these tech giants will lead to a stock market apocalypse, and highlights the success of companies like Apple and Microsoft.
Meta platforms reported spectacular numbers, and their stocks caught fire in after-hours trading, especially Meta, where business is so fantastic that they're going to pay a nice-sized dividend and a boosted buyback. We also heard from Apple, which had strong headline numbers, but China was not so hot, and China is what everyone seems to care about and focus on endlessly, and that's why the stock got dinged in after-hours. Apple, I say even after a report that isn't as strong as that of the Chinese-deprived Amazon and Meta, own it, don't trade it. It's constantly disconcerting to me that people complain about how something must be wrong with the market, given that a handful of tech companies represent such a preponderance of the S&P 500. I always come back and say, what are we supposed to do? Do we give them a haircut because they're so big and powerful? Like some sort of handicap? When they're up against underdog companies, should like those smaller players get extra points to make the contest better? This isn't DraftKings, for heaven's sake. There's no point spread in the stock market. There's no under, there's no over. Oh, and it's not like this is some restricted club where you can be blackballed because someone doesn't approve of your sector. Consider the case of Eli Lilly versus Tesla. You know I've been on a campaign to can the term Magnificent Seven label because Tesla no longer deserves it. Something that a Delaware judge made a lot easier the other day when she threw out Elon Musk's pay package, a package that would have given him roughly a tenth of the Tesla's current market capitalization for doing well. Elon now says he's moving the company to Texas, presumably because no intruding judge will question his compensation. Unfortunately, Musk has now put the idea on the table that it may not be worth his time to take Tesla to another level in artificial intelligence and all sorts of other great stuff. If he doesn't get double the stake in the company, or at least double the voting power, maybe he doesn't want to do it anymore. Musk doesn't want to be challenged by the outfits that analyze pay packages or by activist shareholders who can swoop in without a lot of blocking. I think he's the only CEO of the seven that wants to hold his company hostage for more money, even as most of these other execs deserve a lot more, too. I mean, if you relatively. Against that, how about the more valuable Eli Lilly with a revolutionary drug that's being shown to help diabetes, crush obesity, deal effectively with hypertension, perhaps help the 365 million people who have osteoarthritic knees, or those who have sleep apnea, or who drink too much? Lilly's $627 billion market cap now exceeds Tesla's, yet no one seems to begrudge them for that achievement. Lilly's not called into question the way the tech guys are because it's a drug company. I bring all this up because every couple of days someone comes up with something to question the whole valuation process of the former Magnificent Seven. Yesterday it was Bank of America's turn. They issued a note about managing the risk of magnificent momentum. A note that laments their status as the big dogs now account for almost 20% of the world's market cap. Apple and Microsoft each are nearly the size of Japan, which is the second largest country in the MSCI at 6%. That in itself is supposed to seem ominous, I guess. Even more foreboding are the endless notes crossing my desk about how we have a bunch of undeserving companies leading the market that are totally unworthy of their valuations. Of course, you're told that in the end, it's going to lead to a stock apocalypse, not unlike when the dot-com bubble burst in 2000. To which I come back and I say, will you stop it, please? Enough already. Listen to me. Tonight, three mega-cap companies, Meta, Amazon, and Apple, reported and they collectively generated almost $330 billion in quarterly revenue and nearly $59 billion in net income in one quarter. If you added up all the profits of the top 20 stocks back in 2000, guess what? You probably had a negative number. There's just no comparison with the magnificence. More important, having lived through these days, the executives of these companies spent more time trying to figure out how they could get out of their onerous shareholder lockups or create hidden derivatives that would let them dump as much stock as possible. I know a couple of execs who were busy selling stock right after they spoke positively about their companies on air. Some of them were shorting their own stocks through related entities that were hidden. By 2000, it was all about financial engineering, the kind of engineering it took to take your money, typically small retail investors who first discovered electronic trading then, and engineer a real nice house in Aspen and maybe a bungalow in St. Bart's. Oh, and then when were they allowed to sell stock when they were allowed to? What they do? Okay, these companies did secondary offerings left and right instantly, with a gigantic slug of stock for sale of their own, okay? Helped by shameless analysts looking for a huge payday. There was simply no place to put any of this chimerical merchandise, though. Many of the dot-coms had almost no revenue, let alone profits or even plans to have profits. They were too busy going out to dinner with M&A partners trying to unload their company and salespeople and analysts, all of whom were trying to get a merger going or some sort of activity that would allow them to make some money before the companies went out under. There, that's a great shorter, huh? Of course, there were a couple real ones. I can think of one, Amazon. That made it because it was always a legitimate operation. But I know 330 other companies that came public during the dot-com period, and they were worth billions and billions of dollars in the stock market at the top. 18 months later, most of them were worthless. And yet these are the companies that compared to the Super Six or Eli Lilly or Tesla, that's just insane. Periodically, because of my age, I get to pull rank. I was there right in the scrum, bringing the profitless TheStreet.com public to glowing reviews with $1 billion valuation and no real plan to stop losing money. I didn't like this. I listened, I watched, I heard, I wrote it all down in Confessions of a Street Addict, begging the underwriters not to let it go so high, please, because we couldn't ever equal what the market was saying we could do, given our hideous losses. And the notion of comparing any of these modern megacaps to the best of the dot-com era is fatuous, lacking even a shred of rigor. Here's the bottom line. You may think that these mega-cap stocks are somehow wrongly valued versus the rest of the market. I say you have to value them somehow, some way, and you can't just give them a gigantic bigness haircut because of their sales or earnings. But if you're saying that these companies remind you of 1999 to 2000, I say give me a break. I know who you were. You were probably in third grade back then, if not in Pampers, or maybe the other guys like Love's. By the way, if any of these scare tactics make you cash out of the companies that reported tonight, you can always tell people that you would have made a lot of money, but that money wouldn't have counted. Let's see if anyone believes you. Let's go to Jerry in Missouri. Jerry.
Hey, Jim. Thanks for taking my call.
Of course, Jerry. What's happening?
Well, during the club's monthly conference call last week, in a subsequent video you sent to the club, you mentioned a trade that you like for 4 Chinese companies.
Yes.
So I purchased a few small positions in them, and since then they're all down.
Yes, they are. Yes, they are all
down 10%.
That's okay. I said buy small positions, and I would buy more. These are the cheapest stocks in the market. I have not liked the PRC. But I have to tell you that if you believe that the Chinese have to save their country, as I do, and the PRC has to stop this nonsense, they will start doing things that will amaze you. Remember, I have hated the Chinese stock market more than anyone else in this world. So for me to turn positive and to slowly recommend buying them is a huge change of pace for me. Everyone else burned the hell out of you. I just got started recommending them on a low basis and will buy more on the way down if I could. John in Ohio. John.
Booyah, Jim. Thank you for taking my call. Long-time listener. My question is Spirit Airlines. I bought it in 2020. We obviously know what's happening with JetBlue. Where do you see the future for Spirit?
Here's the future. Sell. Give me a hand here. Sell. Stop it. Sell. Oh, wow. Can we go to commercial? One more question. Todd in California. Todd.
Hi. How you doing, Mr. Cramer? Love your show.
Thank you. I'm trying to recover from a sell button. I'm sorry. What's up?
No problem. Hey, so I'm gonna go.
Yeah.
I'm an ex-PayPal employee. I was at PayPal for over a decade, and while I'm an engineer by trade, I spent the last 5 years in a sales-related role, specifically as a solution architect. I worked specifically with the North American large enterprise merchants and what PayPal calls the global accounts team, which between the two are the largest merchants that PayPal has in terms of revenue and volume.
Okay.
So now I, along with my sales counterparts, spent an enormous amount of time, energy, and money attempting to convince these merchants to move their credit card processing volume over to PayPal.
All right.
In almost every engagement I was involved in, this was our primary charge. This was the end game, was getting the credit card volume from the merchants that PayPal deals with.
All right, sounds reasonable. All right. Look, here's my view on PayPal. There's a guy named Alex Chris. I saw him interviewed by David Faber, my colleague. And I really like what he had to say. And the guy is from Intuit. He's a hitter. Let's own it. Look, am I jumping up and down about it? No. It's like the Japanese stocks. It's inexpensive. You can buy some right here. I really believe that. And you can buy some a little bit lower. It's called investing. I really like it. It's a cool thing. I've done it for a long time. All right, look, you might think the mega caps are overvalued and that we're in a repeat of the dotcom era. Man, I like the way Apple's trading after the bell. I say stop it already. If you keep using the analogy that these are all just a bunch of joker companies, it's going to cost yourself a fortune staying out of the way of Amazon and Meta. All right, maybe get a better basis for Apple. Congratulations. Mad Money today, Brinker, symbol E, the company behind Chili's and Maggiano's, soared today after earnings. So is it time for investors to take a bite of the stock for the long run? I like that. Maybe you can have two of them. I'm checking in with the CEO. And Amer Sports hit the public market today with a bit of a mixed reaction. What a gen I am. So how should you interpret the name and the state of the IPO market as a whole and of that piece of merchandise? I'm sharing what you need to know. And it may not be exactly the take you expected. And Banco Santander, the #1 bank in Spain, reported yesterday. And I'm running through the numbers. And so far, I kind of like what I see. So let's speak to the executive chair and stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.